Hello everyone, welcome back to our 15-minute tax-savvy small business live. Today we are talking about something that honestly makes a lot of short-term rental owners a little uncomfortable. Short-term rental, STR mistakes, and how the IRS actually looks at this during the audit. So let's dive right in and talk about what I see over and over again. The first big mistake is assuming your short-term rental automatically qualifies as non-passive without properly documenting your material participation. And this is huge. Everyone hears that short-term rental can bypass passive loss limitations and they get excited. But the IRS doesn't care what you intended. All they care is about proof. If you're claiming losses against your W-2 or other active income, and you're saying your short-term rental is non-passive, you better have documentation that will show that you actually materially participated and you met the required number of hours. That means time logs. Real ones, not something created after you get the audit letter. The IRS will look at how many hours you worked, what you actually did, and whether those tasks actually do qualify or not. During an audit, IRS agent will ask very specific questions about your involvement. Answers do not go well. The second mistake I see all the time is grouping activities incorrect. Some investors group multiple properties together without understanding the tax implications. Others fail to group when they should. The way activities are grouped can completely change whether losses are allowed. Grouping is basically when you tell the IRS, hey, I want you to treat these rentals as one combined activity instead of separate properties. And the reason people do that is because it can help you meet the certain tax tests more easily, especially around participation and whether losses are allowed. And in an audit, the IRS will examine whether your grouping election was reasonable and properly disclosed. They look at whether it makes sense based on how the properties run, whether you actually followed the rules for making that election. During an audit, an agent may ask, why did you group this? And they will want to see consistency. They will look at whether you manage them in a similar way, whether they're in the same general market, whether they have the same type of operations, and whether you're treating them as one activity year after year. So if you're relying on grouping to say, I materially participate, this is non-passive, you want that grouping to be intentional, defensible, and documented, not just something you checked off because it sounded good. Another common issue is personal use. This one is sensitive because, let's be honest, if you own a beautiful property, you probably want to enjoy it too. Totally fair. But if you use the property personally beyond the allowed limits, your deductions can be limited. The IRS looks closely at the days of personal use versus rental days. And they will ask for booking records, calendar screenshots, Airbnb reports. They want documentation, not estimate. Then another one, we have an aggressive cost segregation without understanding the bigger picture. I love cost segregation when it's done strategically, but I have seen people take massive front-loaded depreciation deductions without considering recapture, future income changes, or state tax impact. And during an audit, large depreciation deductions are a magnet. The IRS will absolutely review the study, who prepared it, and whether it was done correctly. Another big one is deducting everything as if it's 100% business when it's clearly mixed use. Things like travel to check on the property that conveniently included a family vacation, or writing off an SUV under bonus depreciation without sufficient business mileage documentation. IRS loves mileage logs. If you don't have one, that deduction becomes very vulnerable. And here is one people rarely talk about. Not reporting all income. Platforms like Airbnb and others send 1099 Ks. The IRS receives copies. If your reported gross income doesn't match what was issued, that mismatch can trigger notices automatically, even if it's just timing differences or platform fees. It needs to be reconciled on the tax return to avoid this automated IRS notice. Now let's talk about how the IRS actually approaches these audits. They are not sitting there and thinking, how can we destroy this person's life? They are methodical. They look for inconsistencies, large losses compared to income, big year-over-year swings, deductions that are high compared to industry norms. And once you are under examinations, they follow the paper trail. What protects you is not luck, it's documentation and strategy. When we work with short-term rental owners proactively, we focus on three things. Proper classification, because the goal isn't just to save a lot in one flash year. The goal is to build wealth safely and sustainably. And I want you to really hear this part. The emotional cost of doing this wrong is heavy. I have seen clients come to us after getting audit letters. The stress, the sleepless nights, the fear that they might owe tens of thousands unexpectedly, it's not fun. And most of the time, it could have been prevented with better planning up front. On the flip side, when it's done correctly, short-term rentals can be an incredible tax strategy. You can legally reduce taxes. You can offset other income. You can accelerate depreciation strategically, but it has to be structured and documented properly. So here's what I want you to do. We have created a short-term rental audit readiness checklist for you. It walks you through the exact areas the IRS tends to focus on, including material participation tracking, personal use documentation, income reconciliation, and depreciation support. Even if you're watching this on replay, you can grab it. Go through it line by line. Be honest with yourself. If you go through the checklist and you feel completely confident, amazing. And that's exactly what we want. But if you go through it and you feel that little knot in your stomach, that's your sign to get proactive. Fixing things before an audit is always easier than defending them later. As always, if you want us to look at your situation specifically and help you build a strategy that keeps you protected while minimizing taxes legally, reach out. That's what we do every day. Because paying less in taxes is powerful, but sleeping well at night is priceless. Alright, that's it for today. If this was helpful, share it with another short-term rental owner who needs to hear it. And I will see you next week for another 15 minutes of tax clarity.